Welcome to our FAB webinar about building and maintaining credit. I'm Kathy Hill, the Financial Aid Liaison at Laurel Ridge Community College. This webinar is intended to provide general guidance and resources to assist you. I know you're all quite capable of reading, but for our visually impaired friends, I'll be reading much of it on the slides. So let's get started on responsibly building and maintaining good credit. How comfortable are you with your own knowledge about building and maintaining your credit? Well, let's get started to build your confidence. You may or may not realize that consumer credit scores range between 300 and 850. Your credit score represents you, the consumer's credit risk, or the likelihood that you'll pay your bills on time. Potential creditors use your credit score to evaluate that probability. The higher the score, the better a borrower looks to potential creditors and lenders. Your score is based on a number of criteria, including number of open accounts, total levels of debt, repayment history, and other factors. Your credit score is a statistical analysis of your creditworthiness, and it directly affects how much or how little you might pay for any lines of credit you take out. A person's credit score may also determine the size of an initial deposit required to obtain a smartphone, cable service, or utilities, or to rent an apartment. And lenders frequently review borrower scores, especially when deciding whether to change an interest rate or credit limit on a credit card. So today's agenda is 1. Credit reports explained. 2. How consumer credit scores work. 3. Benefits of good credit. 4. Ways of building credit. 5. Credit myths. And 6. Resources. A credit report is a history of your ability to manage credit. Think of it as a college transcript. Just as your academic transcript shows your school grades, a credit report shows your credit grade. Lenders report your payment history, amount borrowed, credit limits, and delinquencies, which are late or no payments, to the credit reporting agencies every 30 days. There are different zones on the report. You have identifying or personal information, which is your name, address, social security number, date of birth, and employment information. All of these are used to identify you. However, these factors are not used in credit scoring. Updates to this information come from information that you supply to the lenders. Trade line information are your credit accounts. It provides a detailed information on loan payments, credit limit, high balance, payment history, etc. Lenders report on each account you've established with them. They report the type of account, whether it's a bank card, auto loan, mortgage, etc. The date you opened the account, your credit limit or loan amount, and the account balance in your payment history. The public record line includes bankruptcies, judgments, court-ordered child support that's past due, liens, repossessions, and foreclosures. The other zone are the credit inquiries. So when you apply for a loan, you authorize your lender to ask for a copy of your credit report. This is how inquiries appear on your credit report. The inquiry sections contained a list of everyone who accessed your credit report within the last 2 years. The report you see lists both voluntary inquiries, spurred by your own request for credit, and then involuntary inquiries, such as when lenders order your reports so that they can make you a pre-approved credit offer in the mail. The credit score model was created by the Fair Isaac Corporation, also known as FICO, and it is used by financial institutions. While other credit scoring systems exist, the FICO score is by far the most commonly used. As I previously mentioned, a credit score is a number between 300 and 850 to depict a consumer's creditworthiness. So the higher the score, the better a borrower looks to potential lenders. What makes up a credit score? A credit score is based on multiple factors. The most common include the number of open accounts, total levels of debt, and your repayment history. Lenders use credit scores to evaluate that probability that you're going to repay the loans in a timely manner. And there are a number of ways to improve your score, including repaying loans on time and keeping your debt low. As I previously mentioned, a credit score can significantly affect your financial life. It plays a key role in the lender's decision to offer you credit. So people with credit scores below 640, for example, are generally considered to be subprime borrowers. Lending institutions often charge interest on subprime mortgages at a rate higher than a conventional mortgage in order to compensate themselves for carrying more risk. They may also require shorter repayment term or a cosigner for borrowers with a low credit score. On the other hand, a credit score of 700 or above is generally considered good and may result in a borrower receiving a lower interest rate, which then results in their paying less money in interest over the life of the loan. Scores greater than 800 are considered excellent. While every creditor defines its own ranges for credit scores, the average FICO score range is often used. Excellent is 800 to 850. Very good is 740 to 799. Good is 670 to 739. Fair is 580 to 669. And poor is 300 to 579. Your score is calculated. Scores are calculated from many different pieces of data in credit reports. This data is grouped into 5 categories. These percentages are based on the importance of these categories for the general population. For particular groups, for example, people who've not been using credit long, the relative importance of these categories may be different. The first bullet on our slide, payment history, which is shown in yellow of the donut graph at 35%. The first thing any lender wants to know is whether you've paid past credit accounts on time. This is one of the most important factors in a FICO score. The second bullet, amounts owed, shown in hot pink at 30%. Having credit accounts and owing money on them does not necessarily mean you are a high-risk borrower with a low FICO score. The third bullet point, length of credit history, which is shown in lavender at 15%. In general, a longer credit history will increase your FICO score. However, even people who haven't been using credit long may have high FICO scores depending on how the rest of the credit report looks. Your FICO score takes into account how long your credit cards have been established, including the age of your oldest account, the age of your newest account, and an average age of all your accounts. How long specific credit accounts have been established, and how long it's been since you used certain accounts. The fourth bullet of new credit, shown in light blue at 10%. Research shows that opening several credit accounts in a short period of time represents a greater risk, especially for people who don't have a long credit history. And the final bullet point of credit mix in dark blue at 10%. FICO scores will consider your mix of credit cards, retail accounts, installment loans, finance company accounts, and mortgage loans. Let's look at a chart on how your score helps or hurts you. In the first column, we have 2 credit scores, one of 660, one of 720. So the difference is 60 points. In the second column, it's $20,000 borrowed. So there's no difference between the two. The third column is where there's a change. Someone with a credit score of 660 gets an interest rate of 10.385%, whereas the person with the 720 score gets an interest rate of 3.24%. So that's a whopping 7.145% difference. So someone with that score of 660, their total loan with interest will be $5,724 compared to the $1,693 for the person with 720. So that's over a $4,000 difference. Since the importance of categories varies per person, the importance of any one factor in your credit score calculation depends on the overall information in your credit report. One factor may have a larger impact than it would for someone with a much different credit history. So your FICO score may be different than someone in your own household. In addition, as the information in your credit report changes, so does the importance of any factor in determining your scores. It's impossible to measure the exact impact of a single factor in how your credit report is calculated without looking at your entire report. Your FICO scores only look at information in your credit report to calculate your score. However, lenders look at many things when making a credit decision, such as your income, how long you've worked at your present job, and the kind of credit you're requesting. Your FICO scores consider both positive and negative information in your report. Late payments will lower your FICO scores, but establishing or reestablishing a good track record of making payments on time will raise your score. Learn more about what a FICO score ignores, how to improve your FICO scores, and how credit scoring helps you, as well as credit score facts and fallacies, can be found on their website, myfico.com. So the following breakdown of where different groups of people fall on the standard 300 to 850 credit score scale gives a better understanding of how much consumers' financial experience can vary. On a positive note, according to WalletHub, the average American has good credit. The average credit score in the U.S. is 715 based on the FICO score model. So the breakdown by range, very good would be 27.5%, exceptional would be 23%, poor is 14.2%, fair is 14.9%, and good is 20.4%. Here's where a credit score gets really interesting. Remember, the purpose of the credit score is to determine whether or not you'll repay a debt. And this chart comes from Fair, Isaac & Company, also known as FICO, the largest credit score producer. They've put together this graph which shows the chance of default, which means unpaid debt, based on your credit score. So on the far left, we have folks with a score up to 499 at 87%, 500 to 549 at 71%, 550 to 599 at 51%, 600 to 649 at 31%, 650 to 699 at 15%, 700 to 749 at 5%, 750 to 799 at 2%, and then 800 plus at 1%. From this graph, if your score is at 750 to 799, the chance that you'll default is just 2%. Another way to think about this is from the lender's point of view. For every 100 people they loan to, 2 of them will default. Lenders charge more interest to those with lower scores in an attempt to recoup the money loaned out. If your score is below 500, there's an 87% chance you'll default. Federal student loans don't require a credit check, so if your score is below 650, you're most likely getting a loan that most lenders would not otherwise provide. Think about it. If you were a lender, would you consider it too risky to provide a loan to someone with a low score? What would be your cutoff point? And here are 8 ways to boost your score. Review your credit reports regularly, pay your accounts on time, keep your credit usage under 30%, limit your requests for new credit, make the most of a thin line of credit, keep old accounts open, consolidate debt, and subscribe to credit monitoring. The 3 major credit bureaus include Equifax, Experian, and TransUnion. They're required to provide, upon request, a free copy of the consumer's credit report once every 12 months. You can request all of your reports at once if you want. You can also choose to obtain a credit report from a different agency every 4 months. Getting a copy of your report every 4 months allows you to monitor your credit more frequently rather than obtaining all the reports once a year. I am doing this myself because I had an account get hacked into, so it's a good idea to do it. Let's talk about credit mistakes. Most people know that maxing out their credit cards isn't the best for their overall finances because it involves spending a lot of money. However, potential lenders also care about how much you're charging to your card, and the more you spend, the more likely you'll be unable to repay that debt. They use something called the credit card utilization rate. The credit card utilization rate is calculating by dividing your total credit card balances by your total credit limits. Typically, this has a high impact on your score. Try keeping your utilization rate between 1 and 20%. This will show lenders that you're using credit, but you don't rely on it. In order to lower your credit utilization, do whatever you can to keep your balances low. If this simply involves spending less money on frivolous purchases, great. Cutting out impulse buys will simultaneously save you money and lower your utilization rate. So ask yourself, do I need it or do I want it? If you're using your cards to pay for purchases you really need and are still using up too much of your credit limit, try making payments more than once a month. This will save you money in the long run by not paying additional interest. Alternatively, you can pay for some of those necessities with cash. And lastly, if you haven't received a credit limit increase in a while and have a good history with your creditor, it doesn't hurt to proactively request an increase in the credit limit or a decrease in the credit rate. Just be sure to ask whether this will result in a hard inquiry so that you can make an informed decision. In points 2 and 3, making late payments or unpaid accounts. We touched on this earlier, but these factors are so important that I'm bringing it up again. Your on-time payment percentage can make or break your score. Lenders really want to see that you're a reliable borrower who will repay your debts in a timely manner. Paying most of your bills on time isn't good enough. Just 1 or 2 late payments could have a drastic effect on your score. Instead, get those payments in on time as often as you can. If you're the forgetful type, set up a calendar reminder. Some folks like to pay bills whenever they get paid, which is typically twice a month. That way, payments get in on a regular basis and they have the money to back it up. 4, applying for tons of credit. Simply put, racking up handfuls of hard inquiries by applying for lots of credit can make you look desperate for credit, which is a trait frowned upon by potential lenders. While 1 or 2 hard inquiries each year may not affect your score by much, a ton of hard inquiries can do some significant damage. Instead, limit your applications and try only applying for credit that you need. So many stores where you shop will offer you deals if you sign up for their cards, so make an informed decision before signing up. If you're looking for the best auto or home loan rate, shop around over a short period of time, within 14 to 45 days. by applying for the same type of credit line each time during that period. Some scoring models will recognize that you're rate shopping and may combine those hard inquiries into just one line. 5. Not monitoring your credit. In a perfect world, you wouldn't need to keep an eye on your credit. There wouldn't be any data breaches to worry about, and you could trust all the lenders and bureaus to keep your information accurate. Sadly, this simply isn't the case. The Federal Trade Commission, or the FTC, reports that errors on credit reports are a common complaint. The study's results line up with data from the Consumer Financial Protection Bureau, with the CFPB, which states that incorrect information is the number one complaint by consumers for their credit reports. The number of complaints more than doubled between 2021 and 2023. It's clear that one of the biggest mistakes you can make is avoiding checking your credit regularly. Instead, perform those regular checkups on your credit and on your finances in general. If you remember from the previous slide, annualcreditreport.com allows you to get a free copy of your credit report from each of the 3 major credit bureaus each year, and it's a great source to take advantage of. Also, Credit Karma allows you to regularly check your credit score for free. And by using these educational sites to monitor your credit regularly, you can make sure your information remains error-free and your credit score accurately represents you. And number 6, excessive number of open accounts. It really relates back to applying for those tons of credit. It's good to have older open accounts, but you might want to consider consolidating debts if you can. How long do they hold on to this information, you ask? Different items that appear on your credit report have different lifespans. Tax liens and Chapter 7 bankruptcies stay the longest and can hurt you longer than any other type of information on report. Here are the 4 general time spans. Indefinitely, so that would be on open accounts in good standing. 10 years, closed accounts in good standing. Chapter 7 bankruptcy and unpaid taxes. For 7 years, late or missed payments. Collection accounts, civil judgments, and paid tax liens. And then for 2 years, credit inquiries. It's important to keep in mind that not all credit inquiries are shared with the credit grantors. These are called soft inquiries. Those are where either you checked on your own credit, a potential employer checked you out, or lenders are pulling your credit for the purpose of sending you offers. Soft inquiries are not included in your credit score calculation. Here are 9 tips for building and maintaining good credit. Pay your bills on time. Pay before the due date. Pay down any outstanding balances. Be sure to check your credit report periodically. Dispute any errors on your report. Protect your identity. Manage student loans responsibly. Shop for just one credit card. And self-report rent and utilities payment to the consumer credit bureaus. To recap, secure those benefits of your good credit by paying your bills on time. Paying on time means sending the payment so that it's received by the due date, not sending the payment on the due date. You can use automatic payments or direct debits from your checking account to ensure the bills are paid on time. This is what my husband and I do. You'll also benefit with automatic payments by saving on postage, reducing the time spent paying bills, and many times companies will reduce your interest rate by 0.25% when you pay with automatic payments. So again, we talked about the benefits of checking your credit report at least yearly. And here's a list of the benefits of good credit and why you should care about that good credit. You'll have more choices for an apartment or house. If you're looking to rent an apartment or the house, your good credit will offer you a wider choice. A bad credit report may limit you to a less desirable area of town. Access to banking services. More banks are requiring a credit check when opening a checking account or issuing an ATM card. If you've bounced checks to your creditors, have any unpaid bills, made late payments, they may choose not to do business with you. I highly recommend that you get to know the people in your bank, not just online banking. They're much more likely to work with you if they know you personally and can help you if you have any fraudulent charges. Better insurance rates and expanded job opportunities. More and more employers are looking at credit reports before hiring. If you plan to work in a bank, some government jobs, or any job involved with money, like in accounting or security clearances, then odds are your credit will be checked. You also get faster loan decisions. Good credit gives you a greater choice of lenders, but you'll also qualify for lower interest rates and faster decisions. If you have perfect credit, there's nothing for a lender to question. However, if you've had a few missed payments here and there, a lender will want an explanation. Increased purchasing power. Those car deals that advertise no money down and low interest rates only apply to people with good credit scores. Your good credit earns you a lower interest rate, and you may not need to come up with a larger down payment. Credit score myths. Closing a lot of credit cards will improve my credit score. Checking my credit report or credit score will reduce my score. My income affects my credit score. With a low credit score, I can never get a loan. Disputing an account will make it come off my report. Credit scores are locked in for 6 months. Medical debt under $500 is reported to the consumer credit bureaus. In April of 2023, the credit bureaus agreed to not list medical debts under $500, even when the balance due is unpaid and in collection. However, this doesn't mean medical providers stop selling medical debt under $500 to debt collectors. It's common to sell to debt collectors when their attempts to get payment are not successful. If you have an outstanding bill, you may want to go online and check that specific provider's billing and collections policy to understand the consequences of not paying. And here are 7 tips for success. 1, monitoring your credit regularly to dispute errors promptly. 2, keep your credit utilization low. 3, pay bills before your due date. 4, student loans. Know how much you owe and keep your service up to date. 5, limit the number of open accounts. 6, don't close too many accounts all at once. And 7, protect your identity. Here are 4 major resources if you want to take a picture. You can also email me at chill@laurelridge.edu if you would like a copy of the URL. So the resources were MyFICO, ECMC Fab, which all of these Fab webinars are based off of their information, the Annual Credit Report, and NerdWallet. Thank you for listening in. I hope I was able to provide some general guidance and resources to help you. Again, personal circumstances vary, so it's not intended for individual financial advice. It's very important for you to do your own research as things do change over time. And again, my name is Kathy Hill and my email is CHILL, so that's chill@laurelridge.edu. Thank you.